Hi guys, welcome back to the channel. My name is Dave, and today we're talking about JEPQ from JP Morgan. So previously on this channel, we talked about JEPI. That was baby number one from JP Morgan in the income ETF space, this covered call ETF. And because of that, we started building out an income portfolio on this channel, and that's kind of what we're doing. We want to see today if baby number two, they went back to the bedroom, got busy again, out popped baby number two, JEPQ, belongs in our income ETF portfolio. Baby number two is always a little suspicious. I know mine, baby number two, judgment is still out. But today let's find out if this belongs in our income ETF portfolio, JEPQ. If that is what you're looking for, please stick around. Whoop. So first off, another crazy week in the stock market. We're back to those lows we set earlier in the year in the S&P 500. And wow, it took a lot, but the VIX is starting to move. So let's look at a chart here of the S&P and the VIX, and we can kind of start seeing it slowly reacting. So basically, this is people saying you shall not pass, because what drives the VIX is implied volatility rising, right? And people hedging their portfolios typically with put options. So if you're buying a bunch of puts, basically saying you shall not pass, or basically if you go lower, I don't really care because I'm hedging my portfolio. But my feeling here is that it took a little while because more and more cash is on the sidelines waiting for a significant drop like we're starting to see. And people are going to start buying back in slowly as we set new lows. So I know I'm starting to nibble just a little bit here and there, but I'm being very selective. Now, as far as JEPQ goes, maybe it's a good one to nibble at. So let's take a look. So JEPQ from JP Morgan is set up just like JEPI, although they celebrate this fund on the NASDAQ versus the S&P 500. So it's constructed a little bit differently, but overall a similar fund. Now the expense ratio for this one, just like JEPI, is 0.35%, which means for every $10,000 you invest, you pay $35 per year to handle the back end of this fund. Now the fund inception date is 5/3/22, which means it's only about 5 months old. It hasn't been around for very long at all, so it's hard to find lots of data points to pull from at this point. Now JEPQ is actively managed in Hamilton, that runs JEPI is over here running JEPQ as well, but we don't call him Hamilton, we call him the Dard Dog or Stu the Dentist. Either one is fine. But he's got two sub dentists as well, Eric and Andrew. So hopefully we'll be well taken care of. But it is professionally managed, so they are making adjustments to this portfolio as they move along. Now, this is something that I do prefer in an ETF like this, where decision making is important. So because we got call options, lots of things going on, I kind of like the setup of having active management. And this slide breaks down exactly how they intend to provide income while maintaining prospects for capital appreciation. So first, they invest in U.S. large cap growth stocks, and they pay out monthly income from option premiums and stock dividends. So this is a covered call ETF. They seek to deliver returns associated with the NASDAQ 100 with less volatility. They buy stocks based on fluffy JP Morgan proprietary data. They sell 1 month out of the money call options to generate that premium and reduce that volatility. And this should give us a solid strategy to deliver some capital appreciation and income, again, with less volatility. So this slide is directly from the summary prospectus, and I'll show you the link here, and I'll link it down below as well. But the investment objective of this fund is to seek current income while maintaining prospects for capital appreciation. So they're doing this two ways. One, they're buying a basket of stocks that is comprised mainly, significantly, of those included in the primary benchmark, which in this case is the NASDAQ 100, but not exclusive to the NASDAQ 100. And then they're also doing this through equity-linked notes and selling call options with exposure to the benchmark, again, the NASDAQ 100. And this slide here is also directly from the prospectus, but it's really important because this talks about their ELNs. So the fund may invest up to 20% of its net assets in ELNs. ELNs are structured as notes that are issued by counterparties, including banks, such and such and such. So I've done a video previously on JEPI, and I'll link that above, and that goes into a little more detail on ELNs. But a garden variety ELN would be an investment, and it's like got two components to it, right? One is a bond that would offer a high probability for principal protection, but it also frees up some of the other money to go gambling and put into a riskier asset like an option. And in this case, they're selling out of the money call options to generate that income. So read down through this and make sure you're comfortable with this strategy, because there is risk involved, but I like the idea of utilizing ELNs in this manner. So let's jump over to Seeking Alpha really quick and take a look at JEPQ. Now I do have to mention that I'm an affiliate. There's some great affiliate links down below if you like this type of thing. But please do not do this to support this channel. Do it to support yourself. If it looks like a tool that will benefit you, then consider signing up. Unfortunately, with JEPQ, we don't have a lot of information like we've talked about. So only about 4 or 5 months here. Yield isn't calculated correctly. It's averaging about 10.5%. It is a monthly paying dividend stock, or distribution, I should say. Expense ratios, like we said, about 35 basis points. But let's jump in. We're going to look a lot deeper at the holdings, but focused on technology, consumer, cyclical, and communication. And if you look at their top 10 holdings, it's Apple, Microsoft, Alphabet, and Amazon. So this is going to expose us to something different than JEPI if you like that fund. The rest of it, what you see here is these index options, these ELNs. So that's the holdings. Again, we're going to dive into that a lot deeper. Now, dividend-wise, as I said, we've only got 4 months of dividends so far. If I look at the dividend history here, and if you're someone that's counting on a certain amount every single month, well, you're going to have to maybe take a look at the average and see how it works out, because we've had 38 cents, went down to 34, up to 41, then all the way up to 55. So it's been all the way, all around the map. This 55 cents, if it was like that all year, it's like 15%. This 34% or 34 cents would equate to about, I think, 9.5%. So you can see it's varied quite a bit. And of course, charting again. We don't have a lot of information here. We have JEPQ versus the S&P 500. Very similar. And even if we adjust for those distributions that they've been paying out for total return, you're going to see a little bit of a separation, but not much. So it's like buying QQQ in a lot of ways. You're not getting a whole lot of information out of here yet, but we're more, moved towards technology. So if you like JEPI, you might like JEPQ to give you a little bit more exposure to those NASDAQ stocks. So now let's take a deeper look at what's actually in JEPQ. Now there's a really cool website out there called ETFRC.com. It's ETFResearchCenter.com. And that shows fund overlap, but unfortunately JEPQ is so new, it's not in their database yet. So I had to do it myself. So I downloaded everything from JEPQ. That's what you see here. And also JEPI, because if we're going to buy both of these funds, we kind of want to know what the overlap is like. I think that's really important. You'd always be surprised at what your exposure might be to something like Apple. We'll talk about that here in a minute. But if we compare both of these together, we start getting a breakdown like this. You can kind of see JEPQ here, Apple at over 10%, Microsoft at 8%, and Google at 6%. Whereas if you look at JEPI, the top one is Progressive at 1.71, United Health at 1.6, and Hershey at 1.5. Much more balanced. And then over here, I'm figuring out the overlap. So we can kind of slide over here and kind of start looking at the overlap. And I summarized all of this together to see exactly what we would have if we mix these two together. And the first thing that I found was there are 33 stocks in all that have overlap between JEPQ and JEPI. Starting with Apple, the largest holding in JEPQ at 10.68%, but only a fraction in JEPI at 0.017%. But as you move down, you can kind of see how some of these offset. So you're going to get Microsoft at 8.41% versus 1.29%. Now as you slide down, it's going to cross over until you see some other common ones that we all know about, like Coca-Cola. 0.71% versus 1.48%, and AbbVie's in there. United Health, go down further, and we see Bristol Myers down here at the bottom, and it's kind of flip-flopped, right? Only 0.33% in JEPQ and 1.46% in JEPI. And if we summarize all this, we get this very interesting slide. At least it is to me. So in JEPQ, after we trim out all the options and the cash, things like that, we have 77 holdings, and with JEPI, 105. Together, they share 33 in common. We've got 44 that are unique to JEPQ versus 72 in JEPI. The largest holding of JEPQ is that Apple at 10.68% versus Progressive for JEPI at just 1.71%, so very balanced. Top 10 of JEPQ account for 43% of the total portfolio, whereas with JEPI, you see only 14.8%, or just about 1.5% per stock in that top 10. But altogether, if you buy both of these, you get 116 unique holdings between these two funds. So I find this very interesting, and an interesting way to play this out in your own mind is what you're getting if you decide to buy both of these funds. So as we're building out an income ETF portfolio like this, fund overlap is really important. So just as a sidebar, we've talked about XLF, the Spider Financial Sector ETF, before on this channel. And the fact that you'd expect the top holdings to be banks, but the number one holding is actually Berkshire Hathaway at 14%. The majority of Berkshire Hathaway at this point, 42%, is Apple. Isn't that interesting? So XLF, the Financial Sector ETF, is 6% Apple. It makes it the third largest holding in the Financial Sector ETF behind JP Morgan and Bank of America. So Apple is everywhere. And that just shows you how easy it is to get exposed, to some of these large caps like Apple. So study your fund overlap as you start to build out a portfolio like this, and it should help you not get exposed too much to one individual stock. So does this one belong in our income portfolio? And I would say yes. It's another good option from JP Morgan. It exposes us to some of those NASDAQ stocks if you want that exposure. It also exposes us to 44 new holdings that we didn't have with JEPI alone. So I like that because as an income investor, in this case, building out this portfolio, diversification is awesome. We want that. It's one of the great ways to hedge risk in this type of portfolio that we're building out. So now would I buy equal amounts? Certainly not. I would probably hedge towards JEPI. I own a lot of Apple. I own XLF. I have plenty of exposure to Apple. So I'm cognizant of that. I'm keeping that in mind as I build out my portfolio. So I don't know. Maybe I'd buy 3 shares for every 1 share I'm buying over here. Something like that. But I would probably err towards JEPI over JEPQ. Now, as far as distributions go, I'd expect them to be about the same. You're going to get a larger premium that you can collect on an NDX option if you sold it at the money, which they're not doing, versus an S&P 500 index option. But at the same time, you're also going to get a larger natural dividend from those stocks that are held in JEPI versus JEPQ. So I'd imagine it's going to kind of shake out and be very similar as you move forward if you're actually looking for which one's going to give you the larger distribution. I'd expect them to be pretty darn close. So now let's take a look at our income ETF showdown and see where things stand. So now we're up to 4 different funds that we were saying yes to and some no's. So we got JEPI, SCHD, DEVO, and JEPQ. There's the expense ratios and the distribution yields. Unfortunately, with JEPQ, that's only based on 4 months, so it gets an asterisk until we get some more information. I would expect that 11.79 to come down some, but that's okay. We can handle it. 1-year total return is also not applicable because we don't know what it is yet, but I expect it to perform somewhere between JEPI and QQQ, kind of holding itself up there pretty well. Now, average distribution yield for those 4 funds would be 7.65%. And yearly, that's $7,650 or $637.50 every single month. That's all based on today's date, September 2022. Now, this style of portfolio is not for everyone. If you want the income, great. If you don't need it, then don't take it and don't pay the taxes. Honestly, right now, if you look at this type of portfolio, it's made for a bear market, which we're kind of in right now, in my opinion. But who knows when we're going to revert and become a bull market. That's the big key, right? So if I was going to say, which could you own, JEPQ or QQQ? I would say JEPQ right now. But when the bull market comes, I want to get back into something with more growth. But if you're of older age and maybe you want that income and you want that consistency and less volatility, this might be the right type of portfolio build that you've been looking for. So JEPQ, another income ETF from JP Morgan that I like. I'll be buying a few shares here and there as the stock market continues to heave a little bit here and there. And maybe they'll come out with that third born and then we'll have more problems. But thanks so much for watching. If you like this type of content, please like and subscribe. And if you have an income ETF that you would like reviewed, I've got a lot thrown at me already, put it down below and we'll try to get around to all of them and see if they fit into our income portfolio here. So thanks so much for watching. Have a great night. Take care. Whoop.